Welcome to Markets Now. I'm Michelle, work with Shawn Hackett, Hackett Financial Advisors. And we did have kind of a mixed trade in both corn and livestock futures today, a down day in the outside markets. We'll talk about that in a moment. But Shawn, I want to talk about the corn market. We've had a little bit of a recovery here off the contract lows with short covering the last few days. But were we trying to put weather premium into that market?
I think we might have been putting a little bit in there. I think what's more been happening, we've been seeing some really, really strong export demand inspections. I mean, 30% year over year for the last 3 weeks, we've been seeing really strong demand. And so it looks like we finally found the place where demand has been stimulated. I think that kind of tripped up some of the shorts. They're feeling like, maybe this is the price level to clear out the corn supply. I think it's more demand driven than weather driven, at least at this point. Hard for me to think that a hot August is going to really excite speculators in the corn market.
Yeah. So what would excite them? What, declining crop ratings, a bigger weather issue, or what? Because technically it looks like we can't get above some of these key moving averages like the 20-day.
I think somehow you have to tell them this is not going to be at least a trend line yield crop. And the only way you're going to tell them that is harvest results coming off combines as they start to roll have to be coming up short relative to what the USDA and many private estimates are looking at. I really feel it's got to be actual results that have to show the market it's not that good of a crop. And, we obviously aren't there yet for that.
Yeah. And that's been kind of wheat's problem here. Not that we haven't bounced off of the lows there as well, but wheat's going to have a tough time getting going here just because we have had really good yield results off the combine, haven't we?
It's been above expectations. Everywhere you look, it was better than we thought, better than we thought for winter wheat. Now it's better than we thought for spring wheat. Yes, Canadian prairies, hot, dry weather, 100 degrees, definitely hurting the crop. Looks like we could be maybe 5% below trend or something. But looking at the North American wheat supply, it's the best we've seen in at least 5 or 6 years. Hard to think farmers aren't going to continue to sell bounces in the wheat market until they've gotten themselves in a better cash position.
And now, even despite what you said about some of this heat moving into the Northern Plains in Canada, in the US, the Wheat Quality Council Tour is finding some really good yields in that spring wheat crop, aren't they?
Yeah, look, we had really good moisture. And you can handle it when you have good subsoil moisture. You can handle some heat and dryness. And it's not really going to cause a problem. The last 3 or 4 years, as you know, we've had no subsoil moisture. So any heat that came in created a problem. We just don't have that set up right now. And I think that tour really squashed any thought that there would be a quality issue, at least based upon that.
So you mentioned that we're stimulating demand in the corn with these lower prices. Are we seeing the same in wheat, or is it only if you have really high quality wheat?
We're seeing it in wheat if you have higher quality wheat for sure. We're definitely seeing 30% year over year increases. Where we're not seeing it really show up in soybeans like we are in corn and wheat. Corn and wheat seems to have been where we're getting stimulation in export demand. I think the reason soybeans is not showing is because right now Brazil can sell everybody anything they want with one phone call. And I think until they clear out the overhang that they have, it can be very, very hard for the soybean market to gain favor with foreign buyers.
Yeah. So obviously, like you said, soybean market a little bit concerned because we're behind pace on both old crop and new crop exports. But, we've had a couple of up days here. We rallied over 40 cents off the lows in soybeans. So did we see a little hedge pressure, or was that profit taking here today?
I think it was more profit taking on some short-term longs that were driving the market higher on this hot, drier forecast for some parts of the Western grain belt. When you have outside markets getting hit like they were, and you have a risk-off trade and commodities in general under pressure, those short-term traders are quick to take some profits. My sense is we haven't traded the entire enormity of the weather that's coming. I still think we have more premium to put on, but it's going to be a little bit of a give and take, 2 steps forward, 1 step back. Today was the 1 step back that sometimes happens when markets are trying to figure out what's the right price level for a weather phenomenon that's coming.
Yeah, and soybeans are an August crop, so that's when we're going to probably put more of that premium in, right?
Absolutely. I think there's going to be a limit, however, because if it's just a Western grain belt drought, I don't think we can create a major problem with soybean yields. However, weather is what it is. It's always, we don't know for sure, but if we were to see an eastern migration of the hot, dry weather moving into the eastern grain belt, that to me is what would be needed to generate an upside more than, let's say, 11:30 November soybeans. I think that's your overhead resistance on the charts. To do something more than that, we would need to see an eastern migration. Obviously, that can happen. Right now, it does not look like that's what's in the cards.
Yeah. So you say part of the correction in soybeans today was tied to the correction in the outside markets. Was that why cotton imploded today? And are we just seeing a carryover from the implosion that started here earlier? Because it's been a slippery slope.
Yeah, I mean, look, whenever cotton is one of the most economically sensitive ag markets out there. So when you have poor economic data, the stock market getting hit, exports continue to be very, very disappointing for cotton. We have the USDA saying we have a big crop conditions are improving, ending stocks are going up. I mean, it's a really tough story right now. What you really need is some weather to concern the market about production having some issues. We've already taken the hot, dry weather off the table. What we need is hurricane activity in the Gulf, like we had a few weeks back, to come back into the play. I think it is going to come. I think mid-August onward, when tropical systems tend to get more active, is coming. But right now, there is nothing on the 2-week outlook for hurricanes. So there's just nothing to drive the market higher. And we're just following the trend down in trend following, speculating, selling.
So we're below 70 cents. How much lower do you think we go?
I think that 66.5 to 67 is your next level of what I would call extended extreme downside potential we could see here. And I think that's where we're going. I think you would stimulate some demand at that price level. And I do believe you're going to get some, all of a sudden, a hurricane's going to start popping up, showing it's going into the Gulf, and we'll get some short covering. But we could go down to that level short term before we turn the corner.
Yeah. So let's talk a little bit about the macroeconomy. Like we said, stock market down hard here today. Is that market rolling over? And what do you see ahead here, especially with the Fed meeting next week?
Well, we've had some very, very weak economic data. We've had some very, very good inflation data. And we have a very uncertain election. And with Biden stepping out and apparently Kamala coming in. And from what I see, the Federal Reserve did not like the way they were treated by the Trump administration the last time they were in there. And I think if they have any way to sway anything, they're going to want to have some monetary stimulus helping the economy going into the November election to try to get some extra votes coming in. It's the economy stupid, they always say. And I know we don't like to think of our public officials in that way, but I think they're all set up to start a rate cutting cycle starting next week. And I think they're going to continue to do that at least for a couple of months, and hope that that's enough to provide some better economic backdrop to get, Kamala or whoever else is going to be on the docket for the Democrats, enough votes to get in. That's what it looks like to me is going to happen. And that's something that long-term is bullish for commodities because it would weaken the dollar, but it has lag effects. So it's not something that's really going to stimulate commodities right now.
It does impact money flow, though, doesn't it?
It does. It really shifts. We've had a strong dollar here for the last year and a half, raising rates. The AI stocks going up, the commodities going down, and we're really starting to shift all these capital flows into a different scenario. So the trends that have been in place, Michelle, are going to really change over the next 12 to 18 months. It's going to be messy for a while, but you're correct. It's going to change capital flows in opposite directions. The opportunity is to understand which directions those are going to change and make sure you, as a producer or a farmer, are factoring that into your marketing plans and to your buying decisions if you're on the livestock side of the equation. So,
yeah, let's talk about that. What does all this mean for the protein sector, especially the cattle market? If the economy slows down, are we worried about demand impacting the cattle or even the hog market at this point?
certainly with the high beef price, that's more of a concern for the cattle market. When I look over at China, they have a massive oversupply of milk. 18 months of declining milk prices. They're herd liquidating the dairy herd. They're flooding the cattle market in China. Cattle prices there are collapsing. I mean, we're not going to see any major imports of beef or milk from China anywhere in the world anytime soon. And if that's occurring at a time that the U.S. consumer is getting more squeamish, it's just not a good outlook for why the cattle market needs to go higher here. It would be a reason for the cattle market to stay stuck or even, bring some decline down. Even the feeder cattle market looks like it might be breaking down on a wedge pattern that we've been developing since the fall. So definitely a precarious time for the cattle market specifically.
Yeah, except that we're going to get into the tightest numbers. So could that trump maybe the fact that demand might be a little bit weaker at that point or not?
Well, it is supply and demand. And I do agree with you that the supplies later on in the year are going to get considerably tighter than they are today, and it will help offset this. I guess I'm talking about the vulnerability here, maybe the next 30 days, just short term potential hole that we might have of too much supply against not enough demand before we get into that extremely tight supply situation, especially if we get clear signs that we're starting to herd rebuild. I think that would overtake demand side concerns. And remember, if you start lowering rates, it will help the economy later on in the year into 25, just not right now.
Gotcha. All right. Thanks as always for your analysis. Shawn Hackett with Hackett Financial Advisors. That is Markets Now.